Hello traders, all I have to say is wow, just wow today. In all of my trading career so far, I have never seen a time where oil has gone negative in a contract. Last night was absolutely one for the ages, and we're about to talk about it right after this intro. See you on the other side. Okay, so here we have oil, the May contract. My God, $1.46, as low as negative 38.96, 200% down on the day in terms of the oil trade for this day. You started at over $11.80 all the way down into 38.76, and then a miraculous recovery all the way back up to $1.46. Now, this is clearly illiquidity at play. When the market dumped, you can see how aggressive that initial sell-off is. That's because there would have been literally no contracts under zero. It's very important for people to understand that illiquidity is such an important factor in markets. If something unprecedented happens, then the move is so fast and so sharp because there are no buyers to buy the contract. What would have happened is algorithms would have stepped in. It would have been so fast in terms of this move. If we broke this down into literally a couple of seconds, you will have seen it just chunking tens of dollars per second. And then the market has hit this low, come up, someone's still been shocked about it, it's sold back off, and then of course rational people have come in and said, well, that can't be negative $40. It doesn't make sense. The hold cost of oil is not that much until contract expiry. So it seemed like people were basically dumping it off for at any cost, but really it's a question of illiquidity. In this video, we will talk about other illiquid events and how you need to be aware that these things can happen when things come under pressure. And I expect during this COVID crisis, we continue to see pressure like this in certain markets. We almost saw it in gold the other day, wild swings, a liquid market, massive spreads. Even some of the big brokers and liquidity providers were actually stepping out of gold and saying, we don't want any part of this anymore. So firstly, let's talk about why oil has dropped this low from a fundamental perspective. It's all about holding cost. It's all about oversupply. We have hundreds of millions of barrels sitting there that are not being used. Not many people are driving their cars. Global economy is shut down. And what you're seeing is storage facilities across the world basically filled to capacity, and now you have a real holding cost on oil. So if we take a look at this New York Times article, we can see that we have 100 million barrels a day, and they're being stored in multiple different areas. Now, obviously, we have the Caribbean, South Africa, Angola, Brazil, Nigeria. All of these warehouses seem to be hitting capacity. Very important, if they're hitting capacity, the cost of holding becomes even more, because where are you going to find more storage areas? Even Donald Trump and other governments around the world are starting to consider buying barrels for the country to try to stabilize oil. It's another move to try to stabilize this massive glut. We have oil refineries not refining oil. They're not basically saying, we don't want to create diesel, we don't want to create petrol, no one's driving. Again, less demand. And as the longer this goes on and the longer the economy stays shut, the shorter date options for oil will suffer. So they're going to be the more dangerous ones. You'll notice if you go, the longer you go on TradingView, Pepperstone, whatever kind of platform you're using, the longer you go out and you look at contracts, the higher price oil is going to be. And that's because there's stability in the idea that we will go back to using oil. So those longer contracts are trading at more of a premium. But for now, short dated contracts, incredibly dangerous, as we've seen last night. So let's jump into the charts and talk about the SP 500. So here we have the SP 500, and last night fell about 2 to 3.5% from its previous highs. Now, pretty large moves, not anything compared to what we've seen recently, but let's talk about some key areas. Over the channel last week, we've been talking about this 2900 zone and how that's going to act as resistance anyway. And any excuse to sell off, especially one such as this unprecedented event in oil, will sell off the market. And we can see it's sitting at about 28.14 right now as of the making of this video. If If we zoom in though on a 4-hour, I think it's very difficult for us to say that the trend is now back down until we see a break below kind of this 2760 support and a break under this 50 EMA moving average. It's very important that it gets down there. Next level will be around 2650, then probably 2450, and then of course previous low testing. So this could be the beginning of the catalyst selling off the market. Obviously, oil traders are scared. The rest of the market should be scared about several things that are going on in the economy. And just because tech companies are doing well does not mean that everybody is doing well. So very important facts here. I wanted to bring up Euro Swiss for everyone because I think people forget too easily what flash crashes look like and what illiquidity looks like. We've seen another one. It's a great learning experience for so many people. But here we have the flash crash of the Euro Swiss when basically the Swiss bank took out the floor. They said, no longer will we provide this floor price, which was 1.2, where they were just constantly buying the currency. And they took it away surprisingly. And you can see very short, sharp, super fast move. It actually went even lower than the price that's here. It went to around 47 cents in 5 minutes. So in 5 minutes, we dropped from $1.20 to 47 cents due to illiquidity. It went so quickly and so fast, and it was just astronomically crazy. Then it obviously recovered, went back up to this kind of $1.05 and slowly recovered over time as people stopped panicking. But that is an example of a flash crash. We have the tsunami in Japan, flash crash on the yen, about 500 to 600 points incredibly quickly. As a trader, you need to be aware of these flash crashes. You need to study them. You need to understand them. And you need to think, this is totally possible. Even in gold a few weeks ago, we saw an illiquidity event come in. Bonds, illiquidity event that was fixed by the Fed. But gold was getting wide spreads, very, very volatile for gold and the way it trades. It's trading $100 a day at one point there. That is the kind of market, when it starts to move like that, you need to practice proper risk management. So hopefully this helps everyone today. That was an absolutely amazing event, seeing oil go under zero. Obviously not good if you're in it, but the wrong way that is, but it is something we all need to learn off. So stay tuned for more videos in the future. Please like, comment, and subscribe to our videos, and we'll see everybody in the Telegram chat rooms. Speak to you soon. Bye.